Gold is hitting record highs, and one financial powerhouse is riding this wave to absolute historic heights. Welcome to an exclusive breakdown of Muthoot Finance's legendary fiscal year 2026 breakout. We are diving deep into how this company crossed a massive 1.8 lakh crore assets under management milestone, while securing a staggering profit surge of over 100%. Let's unlock the vault and decode the massive numbers behind the golden juggernaut. Today, we are looking inside the vault to explore four key areas. First, we will break down the historic fiscal year 2026 big numbers and milestones. Next, we analyze the profit engine, focusing on margins and operating leverage. Then we bust common market myths by decoding physical gold tonnage versus asset quality. Finally, we reveal the ultimate verdict using a comprehensive valuation and risk matrix. Fiscal year 2026 delivered historic milestones for Muthoot Finance. The consolidated loan assets under management skyrocketed to an incredible 1.81 lakh crore, marking a massive 49% year-over-year growth. Even more explosive is the bottom line, where full-year consolidated profit after tax reached 10,606 crore rupees. Profits literally doubled, surging 98% in a single financial year due to exceptional operational execution and booming global gold prices. When you look at the growth dynamics, it is a story of high growth and low drag. Visually, income growth is towering massively over expense growth. In the fourth quarter alone, total income surged 68.1% year-over-year to 8,193.9 crore rupees. This triggered a bottom-line explosion, with profit after tax growing 104.7% year-over-year. This incredible operating leverage was achieved because revenue expanded massively, while employee costs and operational expenses were strictly controlled, aided by smart pricing, where yields were boosted via selective 50 to 100 basis point loan interest rate hikes. This efficiency places Muthoot in an elite tier of global financial services sector profitability. The metrics are jaw-dropping, featuring a golden gauge pointing to a 34.17% return on equity. Concurrently, the return on assets jumped a robust 210 basis points year-over-year to settle at 7.95%. Furthermore, the net interest margin remains strongly protected at 13.38%, backed by an optimized 11.99% interest spread, all while operating expenses to assets under management dropped from 3.9% down to just 2.92%. Now, let's address a fascinating paradox regarding tonnage and asset quality. While standalone physical gold tonnage actually dropped 6% to 196 tons, the overall gold assets under management simultaneously surged by 50%. This divergence happens because skyrocketing global gold prices, sitting at 13,441 rupees per gram, create higher leverage per gram. Borrowers need significantly less physical gold to secure the exact same loan value compared to last year, resulting in a natural, healthy portfolio churn with expanding asset book value. This brings us to busting the Stage 3 non-performing asset illusion. Headline Media reported a risk because Stage 3 gross NPAs spiked to 2.35%, or 3,823.9 crore rupees in the fourth quarter. But the actual risk reality reveals zero underlying credit concerns. This spike is strictly a technical reclassification mandated by the Reserve Bank of India, moving from a loan-wise to a borrower-wise classification. The ultimate shield here is that all Stage 3 accounts are fully backed by gold collateral at an average, highly conservative loan-to-value ratio of just 58%. To visualize this ultimate margin of safety, imagine a secure vault column. While the loan-to-value risk is capped at 58%, the borrower equity margin sits at a highly secure 41% safe zone, strongly incentivizing borrowers to repay their loans. With 196 tons of physical gold jewelry secured in custody, the total underlying collateral is valued at a staggering 263.4 lakh crore rupees. The crucial edge here is that unlike unsecured lending, falling borrower cash flows do not destroy Muthoot's principal. Financially, the company boasts deep pockets and a very safe institutional leverage framework. The capital adequacy ratio stands at an exceptional 20.75%, which is massively ahead of regulatory minimums. The total net worth has expanded via robust internal capital generation to 37,740 crore rupees, keeping the gearing ratio at a very safe 3.46 times. This is supported by a highly diversified funding mix, consisting of 49% bank loans, 26% non-convertible debentures, and 19% senior notes. Growth is also accelerating well beyond the parent entity. Looking at the subsidiaries, Muthoot Money is a rising star that pivoted to pure gold loans, driving its assets under management up 151%, while its profit after tax exploded by an unbelievable 2,689% to 337.5 crore rupees. Meanwhile, the microfinance arm, Belstar, survived sector friction to print a positive second-half turnaround, and MUTHOOTFIN posted steady growth with affordable housing assets under management expanding 17%. The core strategy is clear: safely replicate the highly profitable parent Goldloan model across new brands. When pricing this juggernaut, the valuations reflect an elite 34% return on equity, scaling smoothly without any dilutive equity infusions. The trailing price-to-earnings multiple sits at an attractive 12.52 times, based on a fiscal year 2026 earnings per share of 252.43 rupees. The price-to-book value stands at 3.36 times, paired with a 0.95% dividend yield, representing a record 300% payout, or 30 rupees per share. Evaluating the full investment thesis requires looking at both sides. The bull case is driven by cyclical tailwinds, where high gold prices naturally expand the institutional margin of safety, alongside an elite 34% return on equity that enables rapid, self-funded capital accumulation. On the flip side, the bear case highlights risks like borrower attrition, noting a loss of approximately 13 lakh ultra-small accounts under 30,000 rupees as focus shifts to larger ticket sizes, as well as rising competition from the aggressive entry of deep-pocketed AAA-rated NBFCs into the gold space. A strict quality of earnings check confirms that the financials are rock solid. Are there hidden cash flow issues? No, because a negative cash flow from operations is entirely natural for an expanding NBFC securely backed by highly liquid gold, earning a clear pass. Are earnings pumped by one-offs? No. Adjusted one-off revenue from auctions and recoveries accounts for less than 1.1% of the fourth quarter top line, earning another pass. Are there hidden debt risks? No. The vast majority of liabilities are long-term, with minimal reliance on volatile commercial paper at just 5%, securing a final pass. The final verdict is clear. Muthoot Finance is successfully riding a global gold supercycle to achieve historic scale and profitability. Perceived asset quality fears are mathematically unfounded due to immense collateral buffers and a conservative 58% loan-to-value ratio. What we see is a structurally stronger enterprise driven by powerful operating leverage and robust subsidiary growth, trading as a high ROE compounder at very reasonable multiples. Now it is your turn. What do you think of Muthoot Finance's earnings breakdown? Let us know your thoughts in the comments below. If you found this earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.